before we dive into some questions, I'll give the panelists a moment to introduce themselves and give a little bit of background. So, Shyam, we'll start with you and go from there.
Great. Thanks, Rodney. Hi, I'm Shyam Sankar, Chief Operating Officer of Palantir. I joined as the first forward deployed engineer. I've spent a significant amount of time with our customers in the field. I joined about 15 years ago now as the 13th employee, and I'm pumped to be here.
I'm Dave Glazer, Palantir's Chief Financial Officer. I joined the company a little over 7 years ago.
Kevin Kawasaki, Head of Business Development, coming up on 10 years at Palantir, and excited to take some questions.
Hi, Ryan Taylor. I've been at Palantir for 10 years as of next week, actually. I'm a computer scientist by background, so a true engineer at heart turned lawyer. During my time at Palantir, I've worked both as a lawyer and also in a business capacity, structuring our customer engagements and overseeing revenue. Looking forward to chatting with all of you today.
All right, guys, let's jump in, and we'll start with a question that's obviously very topical, and the reason we're doing this virtually. So the first question is, can you talk a little bit about the impact that COVID has had on Palantir, both culturally and as a business, and how we've responded over the last several months?
Great. Yeah, happy to take that one, Rodney. Thanks. So first, I'll say COVID certainly has had an impact on our employees and our business. I think from a personal level, I know I miss seeing everyone in the office. I miss collaborating with everyone, working together with everyone to help think through and talk through problems in person together. At the same time, it has presented us with unique opportunities, I think, to refine and grow our business. We closed our offices earlier than most companies moving to a remote work environment, and that was in part to be extra cautious and given our global presence. And very quickly, our employees rose to the challenge. We mobilized as a company to be able to continue our business around the world, despite all the constraints that were imposed as a result of COVID. And on the business side, I really think the unique capabilities of our platform helped to unlock a lot of new opportunities for us. It's really been a forcing function for both companies and governments to think about and embrace how they approach digital transformation. And we're in a unique position to be able to help them do that. On the other hand, we haven't seen any notable disruptions in payment timing or revenue generating activity. Customers are still paying. We have no uncollectible accounts, and we've seen no customer terminations. So I think, while it's impacted us all on a personal level, I think it's had we've all felt that. We've all felt the day-to-day grind being a lot harder at times. Overall, I think it's made us even more robust as a company.
If I could just add to that there, Ryan, historically, periods of crisis have accelerated the business. Like, of course, we have present day COVID that we can think about, but also the global financial crisis or the ISIS attacks in Europe in 2015 and 16. And the reason that's been the case is these sorts of crisis situations really make the competition infeasible. It's not viable to say that you're going to wait 3 years for a solution in the context of a crisis. And that gets back to what is it that we actually do? We are providing platforms that help our customers generate alpha. These are central operating systems to their business. And the only alternative to these sorts of things is a multi-year, expensive, slow custom software project. And you're not going to be able to get that sort of alpha from commoditized packaged software. It's only beta. But these sorts of things only make you more similar to your competitors, not more different. And you see the beta actually happening everywhere around here where people are adopting, chat applications or video conferencing applications at breakneck paces, but it's all beta. When I talk to companies, when I talk to prospective customers, I see they're largely frustrated. In the cold light of day, look at the past 5 years of alpha generating or supposed alpha generating IT investments and ask if they actually met their moment in this crisis. And the business folks realize that they can't wait another 3 years. They need something that works now, preferably yesterday. And Foundry was built for a COVID and a post-COVID world. You heard Alex earlier talk about how we build products 5 years before the world broadly understands that they really need them. But the simultaneous supply and demand shocks that COVID brought about, that occurred in the context of the macro disruption of value chains that people were already operating in the context of their industries, really educated the market to that reality. And so accordingly, we've seen a general acceleration, maybe underscored by the fact that we started many, many new engagements in just the first 3 weeks of COVID alone without even being able to get on a plane.
Great. Thanks, guys. So switching gears, this next question is about competition. We've talked a lot about how we view our primary competition as the in-house solution or the desire to build the in-house solution. How is Palantir different than visualization companies, data analytics companies, warehousing companies? Because we must see those companies or other vendors when competing for business.
Yeah, let me take that as well. In our experience, these solutions that are focused on data warehousing or data lakes or analytics or visualization or AI or whatever the buzzword du jour is, that they're not enough. They don't actually have a real impact on operations. In the context of our internal parlance, we would say they stop at the water's edge. They offer insights with no ability to subsequently become the central operating system of that business. And that's profoundly limiting. And we know that because we made those same mistakes 8 years ago. Like, the reality is that most analytic insights are worthless. The only ones that are valuable are the ones that impact operations. You know, if I think back a decade, I think to like all these churn models that would tell you who's going to quit, but would have no intuition for what interventions are even economic. Like, that's not an interesting model. Or predictive maintenance models that tell you that something's about to break when you can do nothing about it. And you really have to flip the problem on its head. Like, have you helped that worker on the front line turn her wrench today? And if the answer is no, you're failing and you just don't know it. And that's why we have focused on building software that grasps into the organic complexity of our customers' businesses and helps them wield that complexity to win. It turns that liability into an asset. And we do that by bringing insight to the decisions they make and helping them learn continuously how to make better decisions. We think about companies as a collection of all the decisions they make and how those decisions are interrelated. Of course, your pricing strategy depends on what's going on with logistics, which depends on what's going on with production, which itself depends on what's going on with procurement. And so we want to bring this together and create a connected company. And as a result, we are wound deeply into the operational fabric of these businesses. And that kind of gets at a deeper truth, something I talked about earlier today, which is the nature of our platforms. Like, our platforms are internal software aggregators. We are aggregating the supply of data and creating the greatest source of truth in the enterprise, well-modeled, ontologized, with security baked in. And we're aggregating the demand for that data in the form of the operational decisions that users make and the users who make those decisions. And so you have this flywheel effect, this sort of critical mass. And once you hit it, the platforms become the obvious place for the institution to solve the next marginal application or problem or use case. And then once you get to that threshold, the software just continues to deliver more and more value for these enterprises, which, when you compare it to the alternative of stitching together a bunch of different packaged software that empirically only succeeds, 1 out of 20 times, it's just not that compelling. And with each failure that our customers have in this context, they are deepening the hole they're in. Like, each one of these kind of broken solutions further fractures the enterprise. It adds to the heterogeneity, and then this just serves to strengthen our ultimate value proposition.
Great, thanks, Sean. So next question, we'll change gears to a financial question. Can you discuss your remaining performance obligation and how is that viewed internally as a performance measure?
Hey, Rodney, I'll take that one. So, as I mentioned earlier, a number of our contracts have termination for convenience. And as a result, RPO, instead of measuring future revenue visibility for us, it tends to measure the length of our termination for convenience clauses. And because our customers rarely exercise their right to terminate, RPO has historically significantly understated our future revenue. And an example of this, at the end of 2019, our RPO for the next 12 months was right around $152 million. And over the first 6 months of this year, we recognized $481 million in revenue. And that was 3x the RPO we had scheduled for the entire year, just in the first half. And so some metrics and numbers we are focused on and that do show the strength of our business: government deal value, which was $1.2 billion as the end of Q2 of this year. Our average customer tenure, which was 6.6 years for our top 20 customers by revenue last year. And then average revenue per customer, which was approximately $25 million annually for our top customers in 2019.
Great. Thanks, Dave. So jumping around here a bit, but we talked a lot about SaaS this morning. But the question is, it doesn't really necessarily seem like Palantir is a SaaS company because we do deploy both on-prem and in the cloud. So is there a lot of customization that has to happen in either Foundry or Gotham to make that happen?
Yeah, I'll take this as well. Let's start with each of those things in turn. So the first question on SaaS, like the magic of Apollo is that it allows us to manage a SaaS solution outside of the conventional notion of a multi-tenant public cloud. And this is really powerful. It's important to understand in the context of our business. It's a massive moat. And perhaps you're right to just be a little provocative. You're right. We're not just SaaS. We're better than SaaS. There is no Salesforce instance on the classified cloud, and there's no ServiceNow instance on a submarine, and there's no Zoom on a drone. But you will find Palantir's platforms as a SaaS offering in each of these environments, in addition to the public cloud. As to your second question about customization, we're selling two software platforms here. And when our FDEs are working with the customer, they're installing one of these two platforms. They're not creating custom solutions. And so we're managing two sets of binaries, two code bases, one for Foundry, one for Gotham. And then at the end of the day, the customer is able to build their own applications on our platforms in as fast as a couple minutes.
Great. Thanks, Sean. So a question on pricing. How does Palantir price at acquisition, and how is Palantir certain that it can get fair value for its platform as it proliferates a business?
Got it. I can address this. This is something that was very hard in the beginning. It was hard to price our software because we had very few data points to base it on, not a lot to benchmark against. But over time, as we've expanded, we've been able to hone that pricing structure, find the right pricing and the value of the platform for that. And now that we've deployed our software successfully in just about every major industry, the experience we have from that is used for benchmarking our pricing. We know where to start our pricing based on the scope, over what period of time that scales, how to address that with customers. And that benchmarking isn't just for pricing. It's also for thinking about solutions across a vertical and across different verticals. So when we go to a potential customer, we're able to benchmark against the scope for similar problems that customers have done, the value of that scope. Whether you're a retailer, a bank, manufacturer, healthcare, whatever industry you're in, we can say, here's what we've done. Here's how fast we can do it. Here's the pricing for what we would do with you based off of comparable benchmarks, and be able to talk through that with the customer. Using an example within verticals, we have a very good sense of how to price AML solutions in the financial services space because we've done it in multiple different customers. Cross-vertical example would be with Vertex, where we solve production problems in oil and gas, but also have helped packaged food companies manage their supply chains. Very distinct industries, but similar problems that can be solved with the same solution. And we can use that experience to help benchmark and think about how we approach the customer, both with regard to the solving the problem and the pricing. To the point about how to ensure the value as we proliferate in the growth of the platform, we showed you a number of our customers growing at an average annual rate of around 30%. We agree to parameters in our contracts that scope the use of the platform. So, for example, we might scope it to one use case, one function, one department, and we focus on the scope of where we can get started first, and then think about how do we grow from there. And we can build in that growth into the contract with our customer, or revisit that scope with our customers to talk through how to expand and grow after we've identified the initial scope where we can deliver value effectively and quickly to the customer.
Great. Thanks, Ryan. So along those lines, we're getting a lot of questions about customer acquisition. So one thing that we talked about this morning was our sales force, which is relatively new. So the question is, why did it take Palantir so long to start building a sales force, and why is now the right time to start committing investments there?
Yeah, I mean, we should talk more about what we're doing with account-based sales. And we started building this team really in earnest kind of beginning of last year. I think in hindsight, the biggest mistake we made was just not doing more of this. It worked really well last year. It's worked well into this year. Why now? Why is this working now? I think lots of reasons, but if you just look over time, we've built up a lot of experience in just about every major market, both commercial and in government. And so, it's rarely the case where we're walking into a new place or a current customer and where we don't have something that we know is going to work for them, because we've done it before. We've done it somewhere else. And, that kind of experience, it's true in vertical sales. So for example, after working with many banks, we know what we should do at the next bank. It's also true with cross vertical sales for capabilities like simulations or digital twinning, which we first did in oil and gas, but now we could take it to, just about any major supply chain, in the manufacturing or retail context, for example. So in some ways, just more experience has given us more things to sell. And Ryan, to go a little more on what you were saying is, because we have a lot of clear comparisons on pricing, well, that's just really helpful for skilled salespeople. We have a lot of examples of doing it before and how that was priced. I think that something that's not super well known here is that, we have a lot of entry points into organizations. We're selling to the business, and there's a wide variety of business leaders at any institution who we can help, and we have a track record for doing it. And, you need salespeople to help find those business leaders and educate them. It's probably also important to understand that, we look at any given year of revenue, a lot of our revenue is coming from existing customers, recurring and growing. And so this isn't just helpful for generating new customers, new logos. Our current customers have a lot of space to grow. And I don't feel like we're providing peak value for any of our customers. So there's a strong installation base to grow on. So if you kind of add, these things up, this is just a really great opportunity for skilled and good salespeople. And so we've hired some great people, but it's early stages and it's working. So look for us to continue to invest here.
Great. So maybe sticking with business model, again, getting a lot of questions on the three-phase model that we described. Can you just spend a little bit more time talking through the three phases and how we apply that to customer acquisition?
Yeah, we could talk about three phases. The simple version is, we tend to operate in negative margin when we're getting our platforms installed, but getting the platform installed leads to positive margin. And that's great business for us because essentially the software stays. We break that installation lifecycle down into three phases: acquire, expand, and scale. Acquire, what we're typically doing here is a no-cost pilot. And if you look at last year, we spent $65 million in this phase, so a lot of potential volume in there. And we think about this as the sort of land phase, the new installation, and ultimately these accounts should grow. If, as the pilot becomes successful, we kind of move into the expand phase. And so what that means is you've probably moved into contracting, you're generating meaningful revenue. By definition, that's over $100,000. The objective in the expand phase is that we should be growing the account, but also finding an inflection point to positive contribution margin. So what does that mean? The customer's becoming independent with the platform, and our team can effectively leave the software behind, which should predominantly be managed by Apollo. The software is managing the software. And when that happens, those accounts tend to be measured in the scale phase, which by definition, these are accounts over $100,000, positive contribution margin. In the end, we want all accounts to become scale phase accounts, and we want to grow this group. To give you a sense of that potential in this group, we're doing 89% contribution margins in the top quartile of the scale group. So you can see what we're striving for here with the three-phase model.
Great, thanks, Kevin. So shifting gears back to product, and Sean, I'm going to bundle a couple together, so bear with me. Are Gotham and Foundry sufficient for Palantir to achieve its growth aspirations? Is there a need to become more verticalized? And is there anything in the product roadmap that is of particular excitement for us?
Okay, thanks, Rod. I'll try to hit all three here. So let's just first start by taking a step back and reminding yourself of the strategy. Our strategy is to build vertically integrated end-to-end solutions. So when you think about are Foundry and Gotham enough? Well, first of all, I think we're a creative company, and I bet that we're going to continue creating really powerful platforms. But in the context of Foundry and Gotham, it's important to remember that we are constantly extending and deepening upstream and downstream of where the platform sits today. They're expansionary. And so there's a lot more that we're planning to do here. You heard about that in the roadmap. I talked about it a little bit. Peter Wilczynski, Martin Manville, and Bianca also talked about it. So I think there's a lot more to go there. But in terms of your second question, verticalization, there's two dimensions that I think are worth focusing on. The obvious dimension is the verticalizations of the solutions themselves. Like, yes, we see that we have modules, or sometimes as we think of them, use case wizards that get companies up and running on really core, repeatable workflows very quickly. Such as, let's just say use anti-money laundering from the bank examples I talked about earlier. We can now deploy a new AML use case in a day or so based on these modules, where the equivalent use case in 2016 would have taken us more than 6 months and a huge team to do. So there's a huge amount of leverage and learning that's happening on a verticalized basis. There's a second dimension that's less obvious, but I think much more powerful, that leads to ongoing differentiation in our product and is the strategic dimension I'd want to call attention to, which is these cross-vertical solutions. They're really driven by our unique access to the problems with our customers and our unique R&D model, the field-driven R&D model that Kat and Jess Eames talked about earlier as well. These things enable us to scale across verticals, across industries, where we're deploying the same solution, the same code, the same application to solve similar problems, but in totally different contexts. Both Kevin and Ryan mentioned Vertex. Actually, Carlos from BP mentioned it as well in the management presentation earlier. And I think this is a great example of this. Like, Vertex as an application in Foundry was used originally to optimize production across wells and oil fields and flow lines. And it's got tremendous economic value in that context. I think it's produced over 100,000 incremental barrels of production a day. But as part of Foundry, that same solution has been deployed at a leading industrial company to help them manage their entire supply chain, a major automaker as they shifted from vehicle to ventilator production, and a national health service to allocate PPE from port to patient. And I think that's kind of the unique power of field-driven R&D, that we can understand what's the customer's problem actually, what does it really look like, and then use a novel approach to build a solution around that will scale not just within an industry, but across industries.
Great. Thanks, Sean. Within the government business, there's a question about administration risk. So how much administration risk is there in the government business, and what might budget cuts do to our growth aspirations there?
Yeah, I'll take that as well. Look, Palantir has operated under 3 administrations in the U.S., 5 in the U.K., 4 in France, 2 in Germany. The people who buy our software, they've operated under many times that many administrations, because they're career civil servants. Our work is not grounded in any one administration. It's just bigger than that. It's more universal. It's more profound than that. On the second question of austerity, I expect that government austerity is actually going to really accelerate the growth of our business in government. Faced with, it seems paradoxical. So it's like faced with budget pressure, our primary competition of a slow, expensive, custom-built project is just not viable. And I would say we've always had a massive deflationary effect on government budgets. You can look at our Army contract and say, wow, $110 million in the first year, that's a very large contract. And it is in some ways, but it's a small fraction of what the Army has spent on personnel systems over the last decade, which I estimate to be about $6 billion. And so there is a deflationary effect there. And historically, the only constraint to rein in the otherwise unfettered desire, the innate human desire to reinvent the wheel, build your own custom project, has been business exigency, that we can't wait how long it's going to take you to build this. But austerity provides another avenue here that I think is going to be really powerful. It's essentially, we can't afford to do the alternative custom project where we need to hire thousands of people. The only option is to buy a solution. And then companies who have invested extensively in the R&D to build unique capabilities over, say, the last 15 years, the last decade, are going to be uniquely positioned.
Great, thanks, Sean. So shifting to margins, there's been a lot of acceleration in gross margin, contribution margin, and operating margin. What are the primary drivers there? Has any of it been tied to COVID or hiring? or has something just fundamentally changed about the way that we go to market that is yielding efficiency?
Well, let me take this as well. In some sense, there's a simple answer and a more interesting, deeper answer. So this is primarily the result of R&D investments paying off. And these investments are driving down cost of revenue and sales and marketing expenses. We could just look at Apollo and software-defined data integrations as examples of this. Like Apollo has drastically reduced, it basically takes the people out of the cost of revenue. If you think about software-defined data integrations, they're like gnarly complexity of dealing with really important operational systems that you need to integrate data from that used to take many months now and require code, now can be done with the point-and-click interface over a few hours. So obvious impact on how it affects cost of revenue. It sometimes is less obvious how it also impacts sales and marketing, because a great deal of our sales and marketing expense are the at-risk pilots, the projects we do to acquire business. And so there's a combination effect there. The other way of seeing this numerically is that headcount is about flat from 2019 to the first half of 2020. And as you know, revenue grew 49% in that period. So flat headcount and meaningful revenue growth on top of that shows you how much leverage we're getting out of the product and the R&D investments we've made. Perhaps the kind of deeper question that is worth exploring is like, well, how are we doing this? And that, I think, is the magic of the forward deployed engineer. And historically, it's actually really helped us that the market has, by and large, misunderstood what a forward deployed engineer is. And as a private company, I certainly wasn't going to correct the fallacious impressions because it was advantageous to us to keep this more or less a secret. But there are two things that forward deployed engineers do that are really strategic. The first is R&D, and the second relates to S&M. And I'm going to take each of those in turn. Forward deployed engineers are a source of continuous R&D and a vector for ongoing product differentiation. And to explain that, I have to kind of back up a little bit. Like all those IT reference architectures that you may have seen, they don't work. Over the last 15 years, I've seen so many different versions of these architectures. They're supposed to be how you solve the problem, solve in all caps here. You know, every year there's some new small tweak to it that incorporates the latest buzzword, and none of them work. And that's actually the role of the FDE. It's to discover what actually does work, to harness these differentiated insights and then build them into our vertically integrated product. You know, they're out there to learn what works, not what a consultant drew on a diagram, not what someone thinks in headquarters, but reality. And then once you learn these things, you capitalize on these disparities, like what's actually true that no one believes to be true. And you solve it in the product. You start with the right predicate. You know, 15 years ago, I was flying back and forth to government customers living in DC basements, and I was discovering all sorts of conventional wisdom that was just wrong. You know, people would tell me that data integration is a solved problem, that NLP is going to replace analysts, that the service-oriented architecture was the future, that Mosaic was the future of the GUI, and just on and on and on. And we figured out what was actually true, and we extended Gotham to encode those deeper, universal, technical truths. And as you can imagine, these insights, they compound on top of each other. And that's what makes the vertically integrated solution such a powerful approach. You have these unique differentiated insights built into the product that layer together. Now combine that with the second point, which is sales and marketing, that FDEs are the ones who are really driving the in-account growth and the new account acquisition. The vast majority of our new account starts begin with at-risk pilots. This is a large sales and marketing investment. And we believe this is a differentiated strategy. Essentially, what we're saying is we're so confident that we're going to be able to solve your problem. Let's solve it first and then discuss on an empirical basis the value of the problem that we've solved. And by the way, we don't want the easiest problem. We want the hardest version of the problem, because that's the problem no one else can do. That's the problem there's no competition for. And so if you combine this approach of S&M and R&D built with the unique model of forward deployed engineers, you get something that's really powerful. You get this accelerating distance between you and the next best alternative.
Great, thanks, Sean. And I don't know if you said explicitly, but I actually have a book called Service-Oriented Architecture directly over my shoulder.
Throw it away.
Great call out. So I know we're a couple minutes over time, but we still have a lot of great questions. We're going to keep going if folks are willing to bear with us, and then we'll get you on your way. But we'll turn back to a financial-oriented question. What is your revenue mix between software and services? We've talked a lot about installation today. How do we as investors get confidence this is a software business and not an SI or a consultancy?
This is an interesting one on the sort of evolution here. I mean, it's interesting because we don't get this question from customers, but we used to, and particularly in the commercial space. I'm thinking about 2014, 15, 16, when our commercial business did look a lot more like a consulting business, at least on paper. But this all changed with Foundry. The path to Foundry, however, did take some effort, and in 2015, 2016, we actually lost some customers because of it. Rodney, I assume that there might be some questions about if we've ever lost customers in here, and we lost some customers here because we were consulting and we were not installing a platform. It wasn't really good enough to just be telling customers interesting things about their data. What the customer needed was to use the technology themselves, to tell themselves interesting things and to operate with it. And, I guess talking about forward deployed engineers in the field learning things, what we learned is that we had to build a platform to meet the customer where they are. And that's what we did with Foundry, and we made it much more efficient with Apollo. This changed our business. We shifted to getting very good at installing the platforms for customers. And, you could just see this in the margins. It's high as 89% contribution margin in the top quartile of the scale phase this year. So we've come a long way here, and this shift is a big reason why we've been able to scale the business.
Great, thanks, Kevin. So we'll wrap up with just a couple of quick ones here. Maybe Ryan, we'll start with you. Where is data stored? Does Palantir house customer data on its own infrastructure? And does Palantir buy or sell any data?
Great. I think fundamentally and most importantly, the data is the customer's data. It's stored in those customers' environments where our platforms are deployed, so in the cloud or on-premise. We do not retain or store any of that data within our infrastructure, and we are not in the business of owning or selling their data.
Great, thanks, Ryan.
Can I just add to that, Rodney? I think this is actually what makes Apollo so strategic, that we can deliver a SaaS platform inside a customer-controlled environment. It's a truly unique capability.
So this next one, Dave, maybe I'll toss to you. How much of your revenue is commercial versus government, and any structural difference in the long-term margin profile between those two segments?
Yeah, so last year in 2019, our revenue split was roughly equal. 53% of the revenue was the commercial segment and 47% government. In the first half of this year, we've seen real growth in the government business. So the split has tilted a bit more towards government. However, we look at this on an annual basis, and we generally anticipate that the split will remain 60-40 in either direction, as each segment scales. And thinking about long-term margins, given the fact that we're deploying the same platforms with the same maintenance infrastructure and selling it with the same sales model across both commercial and government segments, our target margins, should be applicable across both of our segments.
Great, thanks, Dave. KK, maybe I'll throw this one to you. Can and will Palantir look to move down market into SMBs and mid-market enterprises as it invests in Salesforce?
We've seen our platforms scale to smaller institutions. I mean, aviation, for example, we're working at some of the largest global airlines and some of the smallest. They're both using the same product, getting great results. I think even recently, more so with COVID-19, a lot of small institutions adopting our platform, universities, hospitals, research centers, city, state, local governments, smaller organizations. So, I think we're always a little bit worried about doing Palantir Lite, because we want people to get impact with the product. And so although in these cases we're actually installing it very, very efficiently, very, very quickly, they're getting, pretty big impact. So that feel pretty good about that. However, we have a very big market. Our commercial total addressable market, we put at 6,000 potential customers, about a $50 to $60 billion opportunity. We estimate our opportunity in the government space to be about the same size. So, sitting here with 125 customers, we feel like there's a lot of space to grow in our market. So look for us to really focus on that here in the near term.
Great. Thanks, Kevin. And so, Shyam, maybe I'll kick this last one to you, and you can go ahead and close us out. What is Palantir's total headcount? How aggressively are we looking to grow that? And is there anything specific that we're looking for when we go out and hire talent?
Okay. Total headcount, end of year, I think I mentioned this earlier, 2019 end of year to the first half of 20 was roughly flat at about 2,400 people. If you look at average headcount from 2018 to 19, it grew 9%. So headcount grew 9% that year when revenue grew 25%. And from end of year 19 to 20, much stronger revenue growth, it's about flat. And I think that really shows the efficiency of the R&D investments that we've already talked about. On the talent part, I think more meaty question here. We have a high bar for talent, but I'd say an interesting and orthogonal bar to most of the Valley. Like, of course, we want diverse backgrounds. We want eclectic people. We're not looking actually pretty explicitly for people that just fit into a box or have like classic credentialing. We seek out independent thinkers, truth seekers, and people who frankly at the margin are kind of a pain in the ass. They, as Karp would say, for every person, there's a factorial number of opinions. We hire artists and physicists, and those people are rarely the well-rounded candidates. In fact, they're usually the kind of most spiky, most uneven, most unusual, and just most compelling humans. And put simply, if a candidate is talented and ethical, we would welcome them. I guess I'll close it out. Okay. Well, thank you all for joining us for Investor Day and for Q&A. What makes Palantir special to me after all these years, and I think will continue to make it special, is our people. So I would like to close with a special thanks to them. They built the products and they create the privilege that we have, the unique privilege that we have of pursuing our mission. And so special thanks to Palantirians past and present who have proved over and over that not all who wander are lost, and whose resolute commitment to doing the hard thing and not the easy thing continues to remind us that who dares wins. Thank you all.